What's up, everybody? Nate here. So the housing market in the United States has gone through a boom over the last 2 years. This has led investors and everyday Americans to wonder if the situation we're going through right now is going to lead into something like we saw back in 2008. We all remember what happened in 2008. The housing market seemed like it was booming until it wasn't. That bubble surely popped, and now people are wondering if this bubble is going to pop too. From the early 2000s all the way up to 2007 and 2008, the housing market exploded. And then we ended up seeing prices drop in the market by 90 to 100%, meaning if you had a house for sale in 2007 that was worth around $100,000, it would immediately have been worth around $10,000. If something like that was to happen today, it would essentially wreck our economy for a very long time, just like it did back then. But while there are a lot of similarities to what is happening today to what happened in 2008, there are also a lot of differences. Today, I want to talk about what's going on in the housing market and kind of compare it to what happened in 2008 so we can try to predict what's going to happen in the future. But before I get into all of that, do me a quick favor and hit smash or destroy that thumbs up button below and ring that notification bell too. Both of those two things are completely free and they help to show me that you like this video and that you want to see even more just like it. Thank you so much for doing that. Now I want to go over a brief history of what happened nearly over a decade ago in the housing market. A lot of people call the housing market crash of 2007 the subprime mortgage crisis. This is essentially when a bunch of borrowers went to the bank and got a mortgage, but they couldn't quite afford it. They got a subprime mortgage rate, which was a much higher mortgage interest rate than the regular buyer was going to get. Now, the reason that they got a subprime mortgage rate is for a lot of different reasons. Their credit wasn't as strong, they didn't have as strong of employment history, and they were trying to get a house that was probably too far out of their pricing limits. Not only that, but the banks and financial institutions were pushing people into homes because the United States saw buying a home as the American dream. So banks and financial institutions made it very easy for any American to get into a home. This leads us to the big problem of what happened back then and what is definitely not happening right now. When you went into the bank in 2007 to get a loan, you didn't really have to provide any type of financial history. You could essentially walk into the bank and you didn't have to prove your income. You didn't have to prove that you had any money at all, that you were going to put down a down payment, or that you had a job. This meant that the bank was going to give you a loan. All you had to do was say that you wanted a house. Now, this was a problem for a lot of reasons because millions of Americans got into a home, but many of them found out later that they couldn't afford the home that they live in. This created a problem and a perfect storm in the housing market that led to the foreclosure problem and a bunch of interest rates eventually rising all throughout the country. Some Americans ended up getting 30-year fixed mortgage rates, but a lot of them ended up getting an adjustable rate mortgage, a 15 to 30-year arm that basically showed that today your interest rate is super low, so you can afford your mortgage today, but in the future, as the Federal Reserve raises its interest rates, you're probably going to see an interest rate hike on your loan, so you can't afford it anymore. And we're talking millions of Americans that ended up going into foreclosure. They could not afford their home, so they immediately had to put their homes up for sale. This created a really out of whack equilibrium in the housing market because now you had suddenly so many more houses on the market and not nearly enough demand. Now, what also happened with the mortgage crisis back then was the stock market was directly connected to the mortgage market. It still is today in a lot of parts, but back then we also saw mortgage-backed securities start to crash. Investors realized that if they worked with these banks and financial institutions, they could buy an individual's mortgage. So technically you're paying the bank, but then the bank is taking a lot of those asset dollars and reallocating them towards investors. And it was seen as a stable investment because millions of Americans can, one, afford their mortgage, and two, are going to continue to make those payments every single month. So you have a sure bet investing in a mortgage-backed security. But the only problem is if 1 million plus Americans can suddenly not afford their mortgages, well, now your mortgage-backed security is going down. So Wall Street went down, and the mortgage market and housing market also crashed because millions of Americans could not afford their houses. They got their credit tanked, and they also had to make up up for all of those bills later. With all of that liquidity exiting the market, now Americans have no money, so now Americans can't buy anything, which created a lot of instability in businesses and for the stock market because there's a lot less liquidity. So that basically sent us into a recession, and the United States government ended up bailing out a bunch of companies, and the Federal Reserve stepped in with quantitative easing. And what you're probably thinking is, well, Nate, that sounds a lot like what's going on today. Almost exactly. Well, this situation, like I said, while it has a lot of similarities with the United States government and the Federal Reserve, it is very much different than what we saw in 2008. The first thing I want to talk about is with this mortgage lending process. It is a lot harder in 2022 to get a mortgage than it was in 2007. I know firsthand getting a house in 2020 was very difficult. There were so many documents I had to go through, so much paperwork I had to sign before I could actually get a mortgage. This is because the bank wanted to make sure that I had every means possible in order to afford my home. Not only that, but they wanted to make sure that all of the money I was using for a down payment and closing costs was actually my money and it didn't come from some random source. The bank did everything that they had to do to ensure that I could afford my mortgage upon signing. And that gives me confidence that most, if not all, of the mortgages that are being signed in the United States right now, the people can actually afford those mortgages. So we're not in a major dangerous situation where we're facing foreclosures like we did in 2007. That's not really on the table here. I mean, it kind of is. And we'll talk about foreclosures and not being able to afford your home at the end of this video, but for a wide-scale American consumer, foreclosures is not really going to happen. Now, the other thing that was happening in 2007, actually just before 2007, was there was a big push to build a lot more homes. As we saw that Americans wanted homes and that was the American dream, well, builders caught on to that and they started to build thousands, if not millions of new homes all throughout the United States. This meant that even though demand was really high, also we had inventory that was going up. As inventory started to rise, well, then the foreclosure crisis happened, and then all of a sudden inventory was way outpacing demand. So that was all of a sudden a problem. In 2022 though, we're not really seeing that in the housing market. Home inventory is at historically low levels. Now that could mean that home prices get way out of control, and we have seen that over the last 2 years. But it also means that demand is always going to be outpacing inventory in the United States. That pretty much prevents a housing market crash in the short term. Not only that, but in the 80s and 90s and early 2000s, there were a lot of booming subdivisions all throughout the United States. Well, all of that land is pretty much accounted for now, so you can't build new houses on it, so you have to rely on all of those current homeowners to sell their homes in order to increase inventory. But we don't have enough land in the United States that we can definitely build on, and it makes sense to do so, to actually create that much increased inventory in the United States. And then finally, this is something that I don't hear a lot of people talking about, but we have to discuss the generational problem of homes in the United States. In the early to mid 2000s, this was Gen X's time. This was their time after the baby boomers to finally see their best financial years and be in the best financial place possible in order to purchase a home. However, many Gen Xers were not in the financial position in order to outbid a baby boomer. The baby boomer generation is the wealthiest generation in American history, at least at this point, and definitely in the early to mid 2000s. The baby boomers were starting to buy second homes or third homes or upgrading their homes, so they were outbidding Gen Xers almost every single time. Gen X had a really hard time buying homes in the United States, and to add insult to injury, that generation is statistically a lot smaller than the millennials and Gen Z, so there's just not as many people who are able to purchase homes all at once. We always talk about millennials getting shafted, but Gen X had it really hard too. What I'm starting to see in 2022 and what we're going to continue to see for the years to come is that baby boomer generation, their wealth is now trickling down to millennials, Gen Z, and even some Gen Xers. This means that we're going to continue to see more and more Americans getting wealthier. When Americans get a lot wealthier, they start investing and they start buying homes. We are currently going through the biggest wealth transfer in American history. I mean, we're talking hundreds of billions, if not trillions of dollars that is coming from the baby boomers all the way down to millennials. And the other really important thing to note here is that millennials are now in their best and most prime place to purchase a house in 2022 and over the next few years. Gen Z is not far behind. They are now entering their start of their best years to purchase a home in the United States. So while there wasn't a lot of buyers in the early 2000s that could make up for the housing market crash, now in 2022, there are so many more Americans who are able to purchase a home. That makes a big difference because it's going to ensure that demand continues to outpace supply. So that is a little bit of what's going on in the housing market right now and kind of the biggest differences that I see between what happened in 2008 and what's going on in 2022. The bigger question that we need to answer is the housing market going to crash? Are we going to see a crash like we saw in 2008? Well, the first thing you have to know about a housing market crash is technically the only way that the housing market can go down is if inventory suddenly completely outpaces demand. Meaning there are houses available on the market, people are continuing to put their house up for sale, but nobody is bidding. Nobody wants that house or nobody is able to afford it. That would cause prices to suddenly plummet all throughout the United States, which would in turn cause demand to go up a little bit because now more people can enter the market because houses are so cheap. So the question that we need to be asking here is what would cause demand to completely disappear in the United States? Well, we're starting to see home affordability get way out of control throughout our country. Prices are going way up and so are interest rates. So not only are you overpaying for a house right now, you're also paying way more than you probably need to just because interest rates are going up. Now, a crash because of interest rates and high prices can only happen if those high prices and those interest rates stay there. So if the Federal Reserve continues to raise interest rates, let's say to 8, 10, and even 12% all throughout the United States and keeps them there, well, then Americans can now no longer afford a home because interest rates are just way too high. If they want to continue to stifle demand that much, then they're going to keep demand there. That means it's going to be really hard to get a mortgage, and with it really hard to get a mortgage, it's going to be difficult to buy a home in the first place. So prices will most likely continue to stay high. If they stay high for too long though, and nobody's purchasing a home, then the market essentially crashes because eventually demand will be non-existent and inventory will go up. The other thing that we have to consider here is all about Americans' incomes. The first thing that really shows you if an American can afford a home is if they have the money from assets, investments, or their everyday income. Traditionally, you can see the parallel between incomes rising in the United States and home prices all throughout the country. When incomes go up, Americans can afford more, and that includes houses, but if incomes don't rise fast enough, then Americans aren't going to be able to buy houses either. That's going to create a vacuum that basically sucks out all of the demand throughout our country because now Americans have no money to really do anything, and they're not going to be able to buy a house, and they're not going to be able to show a lender that they can afford one in the first place. So we're going to have to continue to see incomes go up in the United States, and we've started to see this in 2020 and in 2021, but the biggest problem that we're running into is number 3, and what I call the X factor. The X factor is going to be a combination of a bunch of different things that are pressuring our economy right now, and the biggest two are supply chain issues and inflation. Inflation hit an over 40-year high of around 8.3% all the way back in April of 2022, and supply chain issues have plagued our economy since the start of the pandemic back in March of 2020. Those two issues are kind of playing off of each other because when you have supply chain issues, well, businesses can't put enough products on shelves for Americans to buy. This means that every time the shelves get full, Americans buy everything, so prices have to go up. Not only that, but it's becoming a lot more expensive for businesses to create things, so they also have to raise their prices. And finally, when you have really high inflation, that means there's a lot of money circulating throughout your economy, which is exactly what we saw in 2020 and in 2021. Now the Federal Reserve is trying to eliminate a lot of that demand, but that doesn't mean it's going to hit Americans' pockets in the short term. What I mean by this is inflation is going to affect a lot of different things. I mentioned before about the foreclosure crisis of 2007, how millions of Americans suddenly couldn't afford their mortgages. Most of this was due to adjustable interest rates for a lot of those mortgages. But in 2022, the problem is very similar. We have rising inflation, which means the cost of just about everything is going up, and that's going to include your housing costs in the United States. We're talking energy, we're talking things like your electricity, electric bill. We're talking taxes all throughout the country now going up. So when I say millions of Americans who've signed their mortgages over the last few years could afford them, they definitely could at that time. But now that taxes and energy costs are going up because of inflation, well, Americans might be running into a problem where they can no longer afford their mortgage payments. And then you also have supply chain problems. So home builders cannot build homes fast enough for people to actually purchase. That means inventory stays really low in the United States and prices continue to rise even though people can no longer afford a house. And then of course, if supply chain issues disappear, well then you have high inflation, but you also have home building increasing too. So now home building is going up, which means inventory is going up, and prices are also going to go up because there's more houses available and demand suddenly grows too. But like I said, that problem gets infinitely worse if we start to see debt continue to rise in the United States. Americans want to put a lot of money on credit cards right now, which means they also have those bills to pay off, and they have rising payments due to interest rates going up and taxes rising in the United States just to live in their home. And that credit card bill is getting more expensive because interest rates are going up, and credit cards all come with an adjustable interest rate. So when the Federal Reserve raises their interest rates, your credit card also gets more expensive. And that's not the only debt. We also have auto payments for a lot of Americans, and we also have regular grocery bills Americans have to pay in order to survive. That is going to hit our economy hard, and it's going to mean that this X factor gets a whole lot more serious. And I think that is the biggest complication that we could see this year that could cause a housing market crash. Millions of Americans suddenly unable to afford their home, so they have to go into foreclosure or they have to sell. Americans don't want to sell their home right now because they just got in at a historically low interest rate, so they're saving a ton of money there, and a lot of them got a really good deal on their house, especially if they bought in the early parts of 2020. So there's not a whole lot of incentive to sell there. But eventually that's going to have to open up if they don't get more money at their jobs and they don't make more money throughout their assets. So really it comes down to money. If Americans spend wisely over the next few years, well, not only could we avoid a recession, but we could also avoid a housing market crash, because then you have millions of Americans who can afford their homes, no problem. I mean, most of them are pushing their budget to the edge, but they can technically afford their home, so there's no crash. What I think we're going to see is an eventual cool off in the housing market because one, the Federal Reserve is raising their interest rates, which eliminates a lot of demand and eliminates a lot of buyers from the housing market. Number two, then we're going to start seeing prices come down. Now, prices are most likely going to continue to rise in the United States, but we're just going to see a lot slower of an increase throughout this year and in 2023. With that happening, hopefully our supply chain issues can improve all throughout the United States and we can start building a lot more homes. As inventory rises and demand falls, we'll get really close to an equilibrium, but I don't think we'll ever see a complete equilibrium, so expect housing prices to continue to go up. There's always going to be more demand for houses than there are houses on the market, which means you're going to see a hot housing market basically forever. Unless the X factor comes in and tanks the entire housing market, which could cause a lot more problems than just a housing market crash. But now I want to hear from you on this issue. What do you think about the housing market crashing in 2022? Do you think there are a lot of parallels between what is happening today and what happened back in 2007? And do you think that ultimately is going to cause a housing market crash? Or do you think what we're experiencing right now is completely different and the housing market is not going to crash anytime soon? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all of the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.